Spain is quickly becoming the main focus of market attention in Europe after the government partly nationalised the third largest bank in Spain and asked banks to increase their provision to cover losses on loans to the property developers by 54 billion to 166 billion euros. And I'm now delighted to welcome Robert Bergqvist, who is the chief economist at SEB, which is one of the largest banks in Northern Europe. Robert, I was flicking through your quarterly outlook and you have some very interesting predictions for Spain.
Well, we expect that Spain must receive a loan of around 150 billion euro, and the reason for that is of course that we have a very difficult economic situation for the country, and also if you look at the banking sector, you have a rising amount of non-performing loans, and I think that kind of developments will continue. So for Europe, I think it is quite important that you are proactive, that you are preemptive, and that you give Spain this kind of rescue loan so that you could get some more stability within the Eurozone. I think it should come within the next 1 to 2 months, because right now we have the IMF is right now present in Spain. They are making a kind of evaluation of the country. We have this informal EU summit coming up within 1-2 weeks' time, and we have also this regular EU summit that will take place at the end of June. So I think a reasonable time should be within 1 to 2 months, and of course it's quite important that you take very important steps right now, because we have still a very uncertain environment, and especially now when you look at the situation in Greece. So I think it's very important that the policymakers in Europe, that they make these kind of very important steps right now.
Just to be clear, this would be a different sort of package than the ones given to Greece and Portugal, which were aimed primarily at their governments.
Yes, and of course it will be a kind of different rescue package, because the previous rescue packages that we have seen for Portugal and Greece, they have been directed towards, of course, government finances and to some extent also the banking sector. But in a Spanish case, the money will be more directed towards the banking sector, and of course it's very important that you create financial stability in Spain, because otherwise you could have negative impact on the rest of the Eurozone. So I think the next step for the Eurozone and the policymakers within the Eurozone, that is to provide support to the Spanish financial sector, but also to inject more capital into the European Investment Bank, so that they can provide money to different kind of structured projects in different countries in Europe.
So where exactly will the money come from? The EFSF, the ESM, or another European institution?
Well, the money to Spain will of course come from the EFSF and the IMF, but the money that we expect that will be injected into the European Investment Bank, that will come from the EU governments, the 27 EU governments, and I think that will be a very important step, that you provide money to the European Investment Bank so that they can promote structured projects in Europe, and that it should also provide some growth support to the overall Eurozone economy.
Let's just broaden out the conversation to Europe as a whole. Do you sense that there is a softening of the stance towards austerity?
Yeah, I think what you see right now, that is a kind of policy shift, that we're going to see more of this kind of growth-oriented structural policies and maybe slightly less focus on fiscal consolidation programs. But of course, it's very important that you keep credibility for fiscal consolidation, because otherwise we are going to see rising interest rates in Europe. But if you would like to solve the very many challenges that you have right now within the Eurozone, you have economic challenges, you have financial challenges, you have political challenges, you have institutional challenges. If you would like to solve all these kind of problems, you must allow and must expect more flexibility when it comes to economic policies. And that includes, of course, slightly less focus on fiscal consolidation programs, and of course more flexibility also for central banks. We have heard about maybe a softening stance from the Bundesbank, and I think that is quite important, that you allow inflation to rise a bit in some countries, because you are going to see very low inflation and some disinflationary forces in some of the crisis countries.
Let's finish with Spain, with unemployment expected to hit 25% this year and the banking and property sectors in a seemingly dire situation. Do you think Mariano Rajoy and his government are doing the right thing by carrying on with the reforms?
I think they are taking steps in the right direction, and based on the experience that we have from Sweden and the problems that we had in Sweden in the early 90s, I think they are taking steps in the right direction. But overall, when I look at the challenges for the Eurozone, I'm still quite pessimistic. So even though that Spain probably are taking steps in the right direction, I see lots of problems, still lots of challenges for the Eurozone, and I'm very concerned about the outlook for the Euro and the Eurozone.
So do you expect a complete breakup of the Eurozone or just some countries to leave?
If I look at the most recent developments in Greece, I think we are, of course, coming closer to a date when Greece could abandon the euro. But if I look at based on the information that we have today and what we see is happening right now within the Eurozone, I think that if we don't see new directions for political decisions, what they are making when it comes to fiscal consolidation, if they don't take steps to create a political union, then I think we are coming closer to some kind of breakup of the whole Eurozone.
Okay, thank you, Robert. Clearly, SEB thinks Spain is going to be central to the next major drama in the Eurozone. That's all for now, but there's always plenty to keep you up to date and informed here on Dukascopy TV. Goodbye for now.